Welcome to QAV TK. This is QAV Australia. We have to point this out now because we're doing a US show too today. Episode 812. It's the 25th of March, 2025. How are you, TK?
Good. But didn't we record 9/11 last week? You're just assigning random numbers to our shows, are you? To confuse people.
It was 8/11. I said it was one short of 9/11.
Okay. So it's actually 101 short of 9/11.
Yeah.
Right.
That's be technical about it. Right. You and your technicalities with price to operating cash flow figures. That'll be a reference to our American show.
Yeah. Rules are rules.
Peak fear day is coming for the markets, Tony. Don't know if you know that. Don't know if you're feeling it. You're feeling the peak fear.
Looking forward to it. Hopefully, it's a buying opportunity. Peak fear.
Oh, that's one way to look at it.
Blood on the streets.
This is according to Chanticleer and the Financial Review yesterday. Peak fear day is coming for the markets. Donald Trump calls it Liberation Day. But the date of his next big reveal on tariffs comes at a risky time for Australia's large superannuation funds. It's Kiss the Ring week for Australia's superannuation sector, a month after Treasurer Jim Chalmers and Australia's ambassador to the United States, Kevin Rudd, hosted a series of meetings for super industry leaders in Washington and New York. You know, if he was an American, it'd be like former President Kevin Rudd.
Mm-hmm.
Why doesn't he get former Prime Minister thrown in there? Like, why do we throw our former Prime Ministers under the bus when they get a new job?
Well, I guess the question is, why did he take the downgrade to Ambassador to America after he'd been Prime Minister? Is he sure to quit?
What else is he going to do? Yeah, well.
Maybe they decided he kept throwing enough hand grenades he could do it from overseas.
Yeah, right. They hosted a series of meetings for super industry leaders in Washington and New York. The big dogs of American capital are making the long trek down under for the second annual Asia Pacific Financial and Innovation Symposium, or APFIS, in Melbourne on Tuesday. The timing of this year's event is exquisite. Australia's $4 trillion super sector is as exposed to the US market as it has ever been, with allocations to international shares hovering around 30% for most large funds. The fact the big US private capital giants are pressing the flesh down under this week tells you there are plenty of Australian savings tied up in American unlisted assets and alternatives. Coming into 2025 with global markets dancing to the tune of American exceptionalism, the super sector's positioning looked pretty smart. Even if veterans such as Australian Super Chief Investment Officer Mark Delaney and UniSuper CIO John Pearce were cautious about overextended valuations and the way US equity markets have been concentrated around a handful of very large, very expensive tech companies. But in the 2 short months since Donald Trump's inauguration as US president, the big bet global investors placed on America is suddenly looking shaky. And April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe, Trump said in the Oval Office on Friday. According to some guy, investors are going to have a hell of a lot to chew on over the next week or so. So there you go. I hope you're shivering in your boots, Tony.
Not at all. I was surprised to see the US market was up 1.8% overnight. I don't know if you saw that. So they're not shivering in their boots. They're looking forward to Liberation Day. Yeah, it makes it sound like it's like the end of World War II, doesn't it? Liberation Day.
It does, yeah. Well, if you look at the last, say, 3 months post-inauguration, you look at the S&P 500, at the beginning of January, it was running at 5975. It's currently at 5767. So it's down a bit. It did get as high as 6144 in sort of the middle of February. It's down quite a bit from that, but it's like not doing, it hasn't had a NVIDIA style collapse or a Tesla collapse or anything like that. It hasn't halved. It's not that kind of a trouncing.
Yeah.
It's been shaky, no doubt.
Yet.
Yet.
There's
Yeah.
plenty of articles out there to say this is the start, but we'll see.
The Dow Jones Industrial Average early December was at 45,014. Middle of February it was at 44,745. It's down to 42,583. So what's that? Come down by 5%?
5%, yeah.
In the last bit, yeah. So anyway, just
ignore it.
As we always say, what was the Batman thing? What do you say, Batman? Just follow the rules.
Yeah. Well, that's right.
Yeah.
I mean, this is just, it's feeding the chooks, isn't it? All this news flow coming out of America. Yes, look, I don't want to underplay it. The wrong kind of macro settings can have big impacts on our portfolios, but it seems like the way Donald Trump is going to handle things is to throw all the stuff out there, flood the field, and then wait for the response and make a final decision or 2 or 3 final decisions down the track. But the US market was up last night because even though Independence Day or whatever it's called, VE Day, is going to bring in massive tariffs. He's already walked it back and said that he's going to waive a lot of car tariffs that he had previously flagged were coming in. So he's getting feedback. And one of the articles I read said that was interviewed the head of General Motors, who said if the tariffs came in as flagged, that they would be broken in 9 months. So you've got to think that that kind of message is getting through to the White House, and they're going to modify things. And yeah, this is another example of talk big, and we'll see what happens when the day comes.
What's it worth to you to remove the tariffs?
Yeah, exactly.
What's it worth?
It's a bit of a protection racket, really, isn't it?
A bit? Yeah.
It's a big one. All right.
Yeah. It's the way it seems to me. What do you have on your list of talking points today, TK?
I have a lot, actually. I wanted to revisit the question from last week, which I must admit came in late and I probably didn't prep for it enough, about the second buy line and the yellow line on the bread loader. The buy line follows the sell line. And just add to what we talked about last week. I went back and checked my notes, and I think the history of the two different buy lines is the green dash buy line, which we now call the second buy line, was the buy line we used from the start of QAV. So it's the most recent line drawn by the most recent high, and the same in reverse for the most recent sell, the most recent low. Well, the biggest low, sorry. The biggest high and the biggest low. The buy line follows the sell line, I think came in during COVID when the market was taking off really quickly, but a lot of stocks were still below their buy line because it was such a precipitous downturn when COVID happened, that the buy line was a long way from where the stocks were, but they were increasing dramatically. And we could see that if they were the stocks were most likely going to cross the buy line, but we didn't want to miss out on the first 20 or 30% growth. And so, I had discussions with Brett and thought about looking at the prior buy line, the buy line that happened after the first buy line that happened after the last sell line, and we were using that. But that really hasn't been used much except for that circumstance. So I just wanted to highlight that to all intents and purposes, unless there's another major crash and sudden rebound, it's the second buy line, which is the important one and the bread loader to use.
Right. So that gets back to my question is, do we need the first buy line or do we just get rid of it?
We can get rid of it, but again, it was useful, I think, when we had that big downturn and rebound during COVID. Because, the buy line as traditionally drawn was way above where the stocks were rebounding from. And we could see there was a fair bit of sentiment happening quickly, and and the numbers were good, and there was no reason not to be buying in that market. And then I went back and had a look at prior buy lines and thought that might be a better indicator in that circumstance. So take it out if you want, but I think it may come back into play again during a unique set of circumstances.
Or just ignore it for the time being.
Or just ignore it, until after
use the second byline.
Independence Day. When the market tanks and we need it again.
Remember that film?
Oh,
Independence Day?
Absolutely.
Early 90s.
Yeah.
Bill, who was the president?
Bill Pullman.
One of the Bills. Bill Pullman.
Mm. Oh, yeah.
Is he the one that's dead, or is it the other Bill that's dead?
Oh, there's lots of Bills. I'm not sure.
There were two Bills, and they actually were in a film together. Bill Pullman's still alive. That's good.
There are much better actors in that movie than Bill Pullman. Randy Quaid, playing the drunken Vietnam vet.
Randy Quaid. God, what happened to Randy Quaid? Like, he went off the deep end.
Oh, yeah.
At one point.
Yeah.
I don't remember what happened to him after
People
that.
out there should not Google what happened to Randy Quaid. And of course, our friend, what's his name from The Fly, and most recently on the retelling
Jurassic Park
of the yes,
yeah,
and all those, he was in it too.
Bill Paxton.
Oh, Bill Paxton.
Bill Paxton's the one that he died.
Mm.
He and Bill Pullman were in a sort of cheesy Corman film that I watched a while ago called Brain Dead.
Were they typecast?
Wow, harsh. It was a low-budget horror film from 1990. Anyway, yes, Bill Paxton. I love Bill Paxton.
Did you?
They're everywhere, man. They're everywhere. And Aliens.
Aliens, yeah.
Tombstone, True Lies, Weird Science. Yeah.
He was in a lot, but
how did we get onto that?
It was a bit generic for me.
Independence Day. I was just thinking of that speech that Bill Pullman gives in the film. It's like this rah-rah American speech. He's talking to all the fighter pilots, to Will Smith and whatever, about they will not. It was like,
today is our day of independence.
Take our homes. Yeah. I get it confused with Mel Gibson's speech in
Braveheart.
Whatever his blue paint face one.
Braveheart.
Yeah, that one.
Yeah. Which, of course, William Wallace,
all right, moving on
Wallace
from
never
2BL.
wore blue paint on his face.
No.
Company news. So, Fendi is back in the news. They've launched the $45 million raising, so that might be of interest to shareholders to Fendi shareholders who would have bought it from our buy list before. Fendi, the ASX-listed ATM owner, backed by the Flannery family, has launched a $45 million capital raising to fund CapEx and to restructure convertible notes held by its Indian investor Piramal Alternatives. The company split the cash call into a $40 million share placement, representing 20.3% of Fendi's shares on issue, and a $5 million share purchase plan. Both were priced at $4 a share, or a 12.3% discount to the last close, and 21.4% lower than the 30-day volume weighted average price. Fendi's core business is setting up and running automatic teller machines for big Indian banks. Its shares have risen 91.6% over the past 12 months, as it won new contracts and broadened out the product offering via bolt-on acquisitions, but the shares have been flat year to date. The term sheet said $22.8 million of the proceeds, alongside debt, would fund CapEx to deploy 2,293 ATMs under a new agreement with the State Bank of India, which initially awarded a contract for 4,219 ATMs in October 2023. A lot of the rest of it would go to paying out Piramal, who had loaned them money, and they said that potential investors were told the restructure would add $7 million after-tax profit after a boost in interchange fees announced this month. So that's from the AFR on the 19th of March.
And when that news came out, the share price jumped, I remember, about 14%, jumped from $4.56 up to $5.44, and today it's down to $4.12.
So just above the issue price.
What the hell?
Strange, isn't it? If you can buy shares at $4, why would you be buying them at $5?
The Fendi shares have been so volatile over the last sort of year or so since we've been paying attention to them. I mean, they've had a good year, don't get me wrong. They're at $3.50 back in January. No, sorry, that was this year. Go back a year ago. A year ago, they were trading at $3.20.
Mm-hmm.
They're up at $4.50 something now, as I said. So they've had a good year, but they were up at $7.38 towards the end of last year. So it's been incredibly crazy levels of volatility, which I never really understood because they've never really come out with any dramatically bad news. It's just been all of this. Oh, Stephen's joining us. All of this stuff that they've been doing in India. It all seems good to me. I don't know why there's been so much volatility.
Yeah, I'm not sure. It goes hand in hand with a growth stock.
Well, welcome back to the show, Stephen Mabb, Chairman of the Australian Shareholders Association, here to talk us through how the ASA is going to represent angry QAV members regarding lack of disclosure during confession season and otherwise. Welcome back. It's been a while, Chairman Mabb.
Yes, thank you very much for having me back on, gentlemen. Lovely to chat to you again. And I have been listening every week, so I feel like I'm in the loop with what you've been covering. But looking forward to the discussion today and hopefully offering whatever help I can.
Tony, do you want to pick it up from there?
Yeah, so lots of examples, Stephen. You and I have talked about them beforehand. I'm still trying to come to grips with what's going on. Another classic example happened today, which we hadn't gotten around to talking about on the show before you came on, but there was there was a disclosure by a company called Helia. There's an article in today's AFR about them being a mortgage insurance lender who looks like they're going to lose their biggest contract with the CommBank, and the shares have dropped a lot. But the interesting thing for me with that was that the CEO sold out a lot of their shares 3 days before the announcement was made. So it's not just continuous disclosure. There's a lot of, I'm going to call it, without picking on this particular example, but a lot of flaunting of the ASX listing rules going on. There have been some, I went back and researched it because I was racking my brains to try and think of when companies had been given a ticket for breaching disclosure rules and other listing rules, and there have been some big cases. I think Rex Airlines were under investigation, if not actually fined by ASIC. I think one of the big banks was as well. But it tends to be large companies where the focus is of ASIC, who seems to be the regulator who can take legal action. I'm not that familiar with the ASX listing rules and whether they can take action, and whether there's a bit of finger pointing going both ways with the regulators. Because if you look at the Corporations Act, it says that Section 674 says that ASX listed companies are required to comply with ASX listing rule 3.1. So it just handballs that straight to the ASX. And then they go through that the listed company must immediately disclose any information that a reasonable person would expect to have a material effect on the share price or value of the securities, and goes from there, with a few carve-outs for confidential information, protected IP and things like that. The Corporations Act had a change a couple of years ago, which said that if they were going to be prosecuted, they could rely on the fact that the prosecutor had to find that they did it negligently or acted with malice, rather than just they made a mistake. So that's made it harder for legal action to be taken successfully against companies, and that seems to have thrown a spanner in the works. And there's certainly less activity going on in the legal prosecution sense and the class action sense that there has been in the past. So I'm not sure what's going on. You might be able to shed some light, but it certainly seems, particularly with the latest reporting season, that a lot of companies came out with results which were a surprise to the market. They were different to consensus, both on the upside and the downside, but the ones that we're particularly annoyed with are the ones on the downside, and whether there should be a change to the rules. And a couple of things I've been mulling is around, if you present results and the stock price moves more than 10%, then the ASX should be all over you saying, well, tell us, why you weren't continuously disclosing the fact that it was going to be a market-moving announcement at the time, and whether you were in possession of any information earlier. That's just one, potential rule change that could happen. But it just seems to me that, if you look at, say, for example, Bendigo Bank, I'll use them as an illustration. They came out with the results. The stock price was hammered. The ASX wrote them a letter saying, please explain. They came back and said, and I'm still blown away by this. They said that we didn't think a reasonable person would expect a reduction in our net interest margin to affect the stock price, so therefore we didn't disclose it. And that, as far as I can tell, that's where the matter rests. Now, I don't know if the ASX or ASIC are going to take further action, but if you're running a bank and you don't think the net interest margin contraction is going to affect the stock price, then I'm not sure where what world you're living in. But why are you trying to manage net interest margin? If it's not that important to the stock price, then just leave it alone. But that's not what banks do. So there's a lot of strange things going on. I feel it's getting worse this particular reporting season, and I'm interested to know whether we can do something about it, both as shareholders and I guess from the ASA perspective.
Yeah, thanks, TK. A lot there, and I guess I'd start off by saying I'm not a legal expert, obviously, and nor is anyone in the ASA management team, but we've gone and had a deeper dig into this since you and I first started discussing it. So a few things that hopefully I can share that might be helpful for people. And the first one is that the ASX actually can't fine companies for breaches of the listing rules. It's an ASIC responsibility to take legal action or fine a company. What the ASX can do is send out these aware letters or these please explain letters, which is normally, what we all see as shareholders when if we're, subscribing to alerts, etc. And then the company has to respond, obviously. From there, if the ASX isn't happy with that response, they can threaten suspension. That's kind of the first step, and ask for more information or more clarification. If they're still unhappy, then they can actually suspend the company, which is the next step, and then ultimately they can delist the company from the ASX itself. But they can't take legal action or enforce any fines against the company. So what apparently often happens is, if the ASX isn't happy or isn't satisfied with the company's response, they will refer it to ASIC. And as far as we all know right now, it's possible that the ASX has referred this Bendigo Bank example to ASIC, and maybe ASIC's investigating. One of the obvious problems there is, ASIC doesn't disclose all of that stuff in advance, and they're also, I think, swamped with more complaints and requests for investigation across all the financial services than they can handle. So obviously, I assume ASIC are trying to manage their workload and determine which of the various breaches are the most significant. And also, I know Joe Longo, the chair of ASIC, has talked a few times about them being more selective with their legal enforcements. And I'm paraphrasing here, obviously, but going after the cases that they think they can win, because sometimes they might think there's a problem there or assess that there might be a problem there, but they're not sure they can win it in court. And in turn, they're not tying up their resources and their funding to go after a case that they're less certain about winning. I'm not saying that's the case with Bendigo. I just mean this is how ASIC are allegedly or apparently prioritising their work. So there's a few steps. Please explain letter, threaten suspension, actually suspend, or delist. Now, if you think through those, there's some consequences for shareholders, obviously, if you do suspend a company, even for a short period of time. The most obvious one being that you can no longer trade the shares while they're suspended. So the ASX are reluctant, I think, to frivolously suspend companies because they know there'll be, at least some of the shareholders then that are unhappy that they can't trade their shares. So from what I understand, it's not their first option to suspend a company. They'll prefer not to suspend someone unless they think it's necessary or needs further action. And I guess sometimes those things are probably judgment calls, aren't they? You know, is the Bendigo Bank result so far away that it was reasonable to expect a big reaction, or not? And those things. I listened to your episode last week, and I couldn't disagree with your sentiments. So it'll be interesting to see whether ASIC actually do take action on this one, if it's been referred to them. The other option, of course, is a shareholder class action. So if enough shareholders are unhappy with what's happened here and they don't think the disclosure has been appropriate, then shareholders themselves can get together with some legal eagles and take out a class action against the company. So that's the mechanism, if you like. I've been following, a pretty small group of companies myself personally for the last few reporting seasons, and I agree there's been a lot of volatility up and down in some of the companies that I've been closely watching. But what's interesting is when I went and had a look at the VIX for the ASX, so the ASX 200 VIX over the last 18 months, it's actually been pretty stable at a market level. So, it's been somewhere between 10, 11, 12, which is kind of quite low by particularly volatile standards. And there's only been a couple of spikes during that period where it's got up to around 15, 16. So when you look at all the companies in total, doesn't look like it's been an overly volatile time. But obviously that's not, necessarily the individual companies that you're following or I'm following where, maybe they have been more volatile than the market as a whole. So there's some things I'd share that, might be helpful. Happy to, take any follow-up questions on that.
Thanks, Steve. Yes, there's a number of questions I have from that. And the first one is, it's kind of a meta argument going on here. If companies are required to maintain continuous disclosure and the ASX is a listed company and it's referring disclosure issues to ASIC, why aren't they being disclosed itself? If action is being taken against Bendigo Bank, and I'm picking on Bendigo Bank as an example, there are plenty of other ones that could easily fall in that same category. Why aren't we as shareholders, I'm not a shareholder, sorry, why aren't shareholders taken into the loop in terms of the fact that that has been referred to ASIC? Has the company been told it's been referred to ASIC? And if it has, why isn't the company disclosing that fact? That sort of link in the chain, as you've described it, is completely opaque. But I would have thought it was very market sensitive, and shareholders should be aware of the fact that ASIC is investigating a company. So, that's the first thing. Why isn't it being made transparent? And I guess, the follow-up question from that is ASIC resourced properly? If it's when I did a search on the prosecutions in the last 12 months, maybe it was perhaps the results were volume weighted, but they tended to be large corporations, Treasury, Wine Group, Star, Casino, Rex Airlines, etc. There was nothing about smaller companies. So does there need to be a separate section of ASIC which is resourced enough to look at market regulation and compliance for small cap stocks?
Yeah, so good questions. As ASA, we love trying to shine a light on anything that we think shareholders should know about, and we're all for as much transparency as possible. So no arguments at all there that it would be better to be aware of these things. I would say the couple of high-profile flare-ups we've seen in the last 3 or 4 months, namely Mineral Resources and WiseTech. ASIC have come out pretty quickly in the media and announced that they're investigating and looking into aspects and calling directors in, etc. So it seems they've acted in a pretty timely or pretty quick manner there. But obviously they're very large and very high profile companies that are getting lots of media attention. So maybe that's forcing their hand a bit more. But yeah, no issues from our perspective, obviously, in terms of, why shouldn't that be disclosed as soon as it's known, or as soon as it could be shared, as long as there's no, confidentiality issues. So I'll go back and find out if there are any specific requirements there. I'm sure once the company has been made aware of that, they probably should be making an announcement, you would think, to the market accordingly. So I'll go back and double check that particular point. And yeah, in terms of their resources, I'm actually having I'm going to a roundtable meeting next Monday with one of the ASIC commissioners. So I might see if I can slip this question in and actually ask around this particular issue, what their process is and how they're allocating resources, etc. I think it's a fairly small group, so hopefully I'll get my question answered. It's not Joe Longo, but it's one of the other ASIC commissioners, so hopefully they'll be in the loop and they can give us an answer there. And yeah, let me know if there's any other questions that we want to pose to ASIC on these issues that are relevant.
Well, if you're talking with them, invite them on our show, because we'd love to have them here and answer these questions directly and in a constructive way without,
Yeah, well, I will definitely ask. We actually have at the ASA conference coming up in May, subtle plug there, but we are actually going to do a regulators panel this year, and we've got Sarah Court, who's the deputy of ASIC, coming to sit on that panel, along with one of the head GMs from the ASX, one of the commissioners from the ATO, and one of the commissioners from APRA. So they're coming to meet with retail or regular shareholders, and it'll be a Q&A session where for 45 minutes we put our various hot questions to the leaders of those regulators and hopefully get some insightful answers. First time we've done that. So, as a ASA member, TK, let me know if you've got any particular questions you'd like us to pose to them in a couple of months' time.
All right. Well, I think you know my questions, but I'll happy to formalise them for you. Are there other opportunities for shareholders to take action, like a REM strike on these issues? Apart from, selling the shares, it's almost a shorting opportunity when the bad news comes out and there hasn't been continuous disclosure, because the market reacts pretty violently downwards to the stock. But, I know that you have monitors. I know that they go along to board meetings and recommend things. But if there's a company you feel that hasn't maintained continuous disclosure, would you recommend a REM strike against it?
Yeah, absolutely. Yeah. And I suspect the big proxy advisors and super funds that, typically are much, larger shareholders than we are, would often be doing the same thing if they feel like the company isn't being as quick or as open with their disclosure as they should have been. I did also hear, I spoke to one of the former GMs of the ASX about these issues as well. And he shared that when they send out these aware or these please explain letters, it is a bit of a tell for shareholders that the ASX doesn't think the company's been as transparent as they should have been. Now, whether they take action or not, it's actually saying that, of all 2,000 plus companies this year, these are the 15 or 20 or 25 or whatever it was that we're not happy with at a first order level at least. And that might be, something to include in the checklist or think about, that the market operator at least doesn't feel it in the first instance that they've been as open with their disclosure or as open in confession season as they should have been. Because it takes, some time and effort to look at these things and send out the letter and then respond to the response. So they don't do it frivolously, is what he said. He said, when there's letters like this going out, it is something you should probably, consider as a shareholder, whatever the outcome.
Do they actually respond to the response? I can't think of any example where I've seen the ASX respond to a please explain letter. It may lead to ASIC doing something, but I can't recall of an example where the ASX has done something.
Yeah, I think they respond to the company, but I don't think the company's required to, add another market announcement around that we got a response and the market operator was happy, right? So I assume if you don't see another response, the market operators said they were happy, or if you do see another disclosure, it's, that ASIC are investigating or the ASX is going to suspend them. Like, they're the next two steps in the process beyond we were satisfied enough with your response where you're not going to get another disclosure.
So as a shareholder, do we assume if we don't hear anything after the ASX please explain it has been replied to, that the ASX are happy with it?
Yeah, unfortunately, it's either that or they've referred it to ASIC, and then I would guess normally in the next few months, if ASIC are going to do something, then you'd be hearing about it then. I don't think ASIC are going to sit on it for a year. I certainly haven't seen that. So I'd say if you haven't seen anything in a few months, you could probably safely assume there was no further action taken. If they've been suspended, that's going to be announced, or if ASIC are starting an investigation, that's going to be announced. So, I guess that's about all we're going to know as regular shareholders with the way it's being applied at the moment.
I guess my overarching comment is that's very Byzantine and opaque, and very unhelpful for shareholders. I won't go any further than that in criticising the regulator, but doesn't seem to tick the transparency box or even tick the helpful box. Apart from your comment that if they send out a letter, it's potentially a red flag. And that's what I wanted to discuss with you. As we talked about last week, putting red flags on companies that we thought had broken continuous disclosure. Our assessment of it was they'd broken continuous disclosure, and we might come up with some rules around that, like, there was a surprise drop in the share price of more than X percent, 20%, for example. My high level, view of the situation is it's the Wild West. ASIC are under-regulated. ASX doesn't have the legal ability to do anything but suspend, and it's not in their interest to suspend because they collect listing fees from these companies for a start.
Sorry, just on that one, on the listing thing, I should have mentioned that. I did ask about the listing fees, and they said that the listing fees are paid a year in advance. So if you're suspending a company temporarily, it doesn't impact the listing fees or the revenue ASX are generating at all. It'd only be if you permanently suspend or delist them that they then lose their revenue from that particular company. So a short-term suspension there's no disincentive, I suppose, there for ASX from a revenue point of view, other than, again, potentially there's other shareholders that are unhappy that the shares are suspended.
Well, except that if just say, for example, the ASX did temporarily suspend anybody that they thought, all the people they've written, please explain it as to, eventually companies are going to stop listing with the ASX and go to a different share market. So there is a conflict of interest, I think, there in the ASX. And look, I don't necessarily have a problem with that because it's ASIC who are the regulator, right? The ASX are just facilitating things. So there's that. But if we don't see what ASIC are doing and we're not seeing anything coming out of ASIC, then we can't have confidence in ASIC. So it's really the Wild West, unless it's a big, highly watched company like WiseTech or Mineral Resources or whatever. We're reliant on Rear Window to uncover those things. We're not reliant on ASIC uncovering those things or the ASX uncovering those things. Let's be clear. It's investigative journalism that uncovers those things. It's the Wild West. And so we have to really, as shareholders, take our own actions. And so getting back to my question, I'm trying to formulate a set of red flags, rules that we can take ourselves. And so I'd welcome your input onto that. And it comes, in my mind, as I've been trying to toss this over, it comes down to the question of if the share price is down 20%, for example, 30%, whatever, it's the age-old question in the share market. Is that a buying opportunity or is that a selling opportunity? And so, my immediate reaction was to slap a red flag on something, but it may be that all the bad news is out of the stock and it's time to buy. So I'd like your input onto doing things for ourselves, I guess.
Yeah, so I can share that, I personally have added to my checklist, do I trust management, as a go, no-go. And if I can't answer in the affirmative there, then no matter how good the fundamentals are, I no longer will own a company like that. And that's, a judgment call, of course, but there's 5 or 6 things I'm regularly looking at there now. And this would definitely be one of them. If they're not disclosing material differences from what they've guided or the market expects in advance, can I really trust that management team? I'm not sure I can. So that would just be my personal view on that. I will say, though, there's companies that don't give formal guidance, right? So take Data3, for example, which is an ASX 200 company. They very deliberately and for a long time have not given any formal guidance. They don't want to get into the forecasting game, which, resonates with QAV, I think. But there's a bunch of analysts that cover Data3 and they come up with their forecasts for what their sales and revenue are, etc. And my understanding is even then, if the company believes that their results will be more than, I think it's 10% higher or lower than the consensus of the major analysts covering the company, they're then supposed to disclose that in confession season. So even if they're not giving guidance, they're still kind of being forced in a way by the ASX rules to update the market when they're expecting to deliver a result materially different to the analysts' forecasts.
Can you point to that rule? I've heard you speak about that 10% rule, but I couldn't find it when I had a look myself. The rules, as I see them, are fairly generic, and you can drive a truck through them, really.
Yeah, I'll go and find that, TK. I don't know the exact listing rule number, but I'll go and find that because our policy managers, come back with me a few times. So yeah, I'll go and find out and come back to you on that one. But yeah, take data 3 as an example. It's been very volatile around the release of half or annual earnings, and yet hasn't diverged much from the analyst consensus at all. So I look at that and go, well, this is either a buying or a selling opportunity if you think it's extreme, because its share price has moved 10, 15, 20% in 1 or 2 days, and then within a week reverted back to where it was. So I don't really want the ASX to send them a letter there, because it's other shareholders that seem to be driving that action. It's not that they delivered a result that was wildly different to what they had been delivering and what the consensus was. It's just for some reason there's been lots of other shareholders buying or selling at that particular week. So to me, that's different to the Bendigo Bank example, where they've delivered a core financial result that's very different to what was expected, and it's something that reasonably you would anticipate would affect the share price. So I see a difference between those two things, where it's other shareholders reacting to what's a business as usual result versus not disclosing things that the market really should have known about.
Yeah, but look, I take your point. Data 3 is a good example. You don't have to provide guidance, but if something happened internally within Data 3, like a data center caught on fire or something, they would have to announce it to the market as part of continuous disclosure. So there's still, you don't have to provide guidance, but you're still obliged to update the market if something's happening within the company which affects the share price.
Oh yeah, 100%. Completely agree with that. I just mean where you're not giving guidance about what your earnings or your sales result was going to be, even then you're still required to update in confession season if your result's going to be materially different to what the analysts' consensus numbers are. So yeah, that's probably all I could offer there.
The other thought I had too was, is there some kind of implicit information in the market when a company doesn't make a disclosure during confession season? Normally I would take that to mean that when the results came out, they're going to be within a narrow range of consensus, but clearly that hasn't been the case this time. So does the ASX need to have a listing rule saying as soon as the books are ruled off, when they go to the auditors, for example, you must update the market with what you think the results are going to be, as almost like a pre-result announcement, and you have to do it. It's not whether you think it's, you have to confess, or whether you think you're away from guidance. You have to do it as a stage in the process.
Yeah, possibly. That might be a good additional disclosure. I guess, typically we'd be getting that info probably only a week or two before we're getting the actual report at that point, right? So it would be nice to know, but it's not like you'd be getting it months in advance if it's when the auditors have looked at the books and then signed it off. Because typically they bring those half or annual reports out within 6 to 8 weeks of the end of that period. So during that time, I assume, CFOs and auditors, etc., are getting everything finalised to go in the report. And yeah, I wouldn't think they're sitting on that for an extended period of time. So it would probably help a little bit, but my guess is you'd only be getting that a week or two before the actual final version of the half or the annual report was coming out.
Yeah, and that's a question too, isn't it? So you're right. You're only getting it earlier, but companies that do provide continuous disclosure, once they know, come out and say it even if it's only a 3 or 4 weeks before they present their audited results. But what we're finding is that companies are just speeding through that and then getting to their annual results and delivering clangers in the last reporting season anyway.
Yeah, absolutely. So look, I will raise these issues in the public forum with the ASX regulator and with the ASIC regulator in a couple of months' time, get it on the record. We'll have many representatives from the FIN and the Australian and the ABC there, most likely, covering the conference. So hopefully we'll get a bit of media coverage for that as well if we're lucky, and then I'll obviously get back to you in a couple of months with what their responses were to these follow-up questions, because I think they're all really valid, and us as individual shareholders obviously do get affected positively or negatively by these kinds of things. So no pushback at all from us on trying to get the better enforcement and better disclosure if we can.
Terrific. Thanks, Steve. That's great. I might put pen to paper and formalise some questions for you to ask.
Yeah, that'd be great. And then I had a couple of quick questions kind of segueing on this issue for listeners. If anyone wants to, shoot Cam a response if you've got one. These are a couple of things that have just bubbled up in the last few weeks at ASA that we're thinking of pushing forward with to try and help regular shareholders. And the first one is around donations. So, when companies are giving political or charitable donations, we saw a lot of this in The Voice, for example, where, companies were making donations to, different sides of the Voice campaign. And we had a lot of shareholders that were unhappy one way or the other about that. So one of the things we were, considering is should we ask for a shareholder resolution at AGMs? And maybe it's a non-binding resolution, but shareholders get to have a vote on it, just like they do with remuneration each year, to explain what your political or charitable donations have been for the year and how they tie to the business. So what is the alignment with the strategy or the purpose of the business? So for example, if you're an insurer, and you made some charitable donations, maybe it's a good idea to make some charitable donations to troubled youth organisations because, you're paying out lots of car theft cases from youths stealing cars, for example. So that might be, a sensible way to make a donation tied to the purpose of your business and how it might positively affect your business over time. So we're thinking it could be a nice idea to shine a bit more light on this. If the board or the management team are giving away company money to political organisations or charitable organisations, why are you doing that and how does it tie to your strategy and give shareholders even just a non-binding vote on that from time to time. So that's one idea. And then the other one was actually about capital management. So one of the things ASA has been arguing for many, many years is for fair capital raisings for small shareholders. But often what happens is the company will do a capital raising and maybe it's, unfair or, imbalanced towards their small shareholders, but it's already happened. It's too late to do something about it at that point. So the other thought was, do we ask for a non-binding resolution as well from time to time on the capital management structure of the company in general? What's your approach to managing capital? And if you do need to raise capital, how do you intend to do it? And then if they do diverge away from that, you need to explain why you've diverged away from your stated capital management policy. So given, these are, particularly the second one's a very important thing for shareholders, the way that the board and management team are thinking about managing the capital of the company, it could be a nice short statement, just like the remuneration report and just like the corporate governance statement that covers the way the company's thinking about and approaching and applying these things for shareholders to A, be aware of, and B, have even if it's non-binding vote on it from time to time. So we'd be interested in obviously your thoughts and also the thoughts of any of the QAB members on those couple of ideas that we might be able to push forward with over the next couple of years.
Yeah, look, I'm happy to give you my thoughts and pass on any listeners' thoughts as well. On the donation side, this has been an issue for years, and it's comes out from time to time in the cultural wars on both sides of politics. Generally, the larger companies will give to both major political parties, and if you ask them why, as people have done at AGMs from time beginning, they generally say something like, well, we're not biased in who we give to, but we have to give to because it's part of our access to the government of the day. And, it's important for us to have doors open to present our case when regulators are considering changes, that kind of thing. So I get that. There have been cases where companies have donated more to one side of politics than the other. And that, my experience is that generally comes out in the rear window type columns in the newspapers. There's been, cases where ex-political operators have become chair of companies and they've pushed donations to their old party, that kind of thing, and it becomes known. So it gets out. Whether it should be a shareholder vote, that's an interesting question. I'm not sure. That's the first one about political parties. The second one is, of course, is about other groups, particular charities or whatever. And we, as a broad brush, I I'm supporting corporates for donating to their charities, and the idea of the triple bottom line, I think, took hold about 10 years ago and seems to have gone by the wayside of recent times. But there was a lot of benefit in companies broadening their footprint in the community and helping community charities to support their end users, and so I kind of support that. Whether you need to do it case by case, it tends to be just like a budget line item that goes to corporate affairs or to HR to make those donations. So my general feeling is manage it on a case by case basis, rather than have everything be put to shareholder votes, because it'd be a tedious task, and there's enough red tape in corporations at the moment. Even though I'm arguing for more regulation on continuous disclosure, so it's there's a lot of regulation out there anyway. So that's my feeling on that issue. On the issue of capital raisings, I think from memory there's a 10% rule now, which comes up at AGMs from time to time, where a company will have in its constitution it can from time to time raise capital up to a ceiling, which I think is 10%, without having to go to a vote or a prospectus. And that's usually when that's kind of discussed, and there's an outline of any potential things that are coming up that the company might need to raise capital for. It's a tricky one, because where do you draw the line on needing a prospectus? Where do you draw the line on needing a vote? And I think, in my mind, if the company was raising up to 10%, people aren't being diluted horrendously, but it gives them flexibility to act quickly if it's an acquisition, for example, or if they need something else quickly to act quickly for. So they're my thoughts.
And I wouldn't disagree with any of that. I guess the idea was just to have that that policy or that thinking spelled out in advance, so that you're well informed if you are thinking of buying shares in that business, or you already own some shares in that business. So on the donation side of it, we ask the companies every year, if they do make donations, to disclose it in the annual report, but they don't tie it to the purpose or the strategy at the moment. So that was the thinking. If you're making donations of any kind, why do you do it and what's the purpose? And hopefully they've got a good answer for that, rather than it just being a pet project or a passion of a particular board member that year or whatever it might be. So it wouldn't be about saying, no, you shouldn't do that, but just giving shareholders a chance to have a non-binding say on whether they're happy with the way that the company's using those funds. And then on the capital management side of it, yes, you're definitely right about, the amount of capital that could be raised without requiring shareholder approval. But the question for us as smaller shareholders here is, obviously, if you do need to raise capital, what format are you going to use? Are you going to give us an SPP? Are you going to give us a pro rata raising? Like, how are you going to treat us as smaller shareholders in a regular capital raising situation? Or if you're in an emergency situation, what would you do? But also you could be asking them for things like, what's their payout policy? What's the board thinking about an average dividend payout policy as part of managing their capital base, etc. So there could be a few things like that in there where they just give you a better idea about that. And it might actually make some of these boards and management teams that aren't great capital allocators think a bit more about these things, if they had to actually put it to shareholders, even in a non-binding way. And then you would get some pretty good feedback as a board and a management team from your shareholder base then too, to say, 95% of our shareholders are in favour of what we're doing, so let's keep doing it. Or 50% are against, we've got a problem, we need to rethink this. So yeah, just thought, leadership ideas at the moment, but yeah, thank you for your thoughts, and if anyone else has got any thoughts, let us know, and we'll we'll see whether we push those forward in any way in the next 12 months.
Okay, back to me. I have something here while you two were talking away. This is the ASX listing rules for continuous disclosure. Listing rules 3.1 to 3.1b, Section 7.3, market-sensitive earnings surprises. I'll just read this out. Generally speaking, an entity's earnings for a particular reporting period are not required to be reported to the market until the due date for the release of that information under Chapter 4 of the listing rules. However, for many entities, the market's expectations of its earnings over the near term may be a material driver of the price or value of its securities. Those expectations may have been informed by earnings guidance the entity has given to the market. In the case of entities covered by sell-side analysts, the earnings forecasts of those analysts, or the entity's PCP earnings. Those expectations may also have been informed or modified by outlook statements made by the entity in its last annual report or at its last results announcement or annual general meeting, other disclosures the entity has made to the market over the reporting period, and market-wide or sector-wide events that can reasonably be expected to affect the entity. If an entity becomes aware that its earnings for the current reporting period will differ materially, downwards or upwards, from market expectations, it needs to consider carefully whether it has a legal obligation to notify the market of that fact. This obligation may arise under Listing Rule 3.1 and Section 674 if the difference is of such magnitude that a reasonable person would expect it to have a material effect on the price or value of the entity's securities, referred to in this guidance note as a market-sensitive earnings surprise. Alternatively, in the case of an entity which becomes aware that its earnings for a reporting period will differ materially from earnings guidance it has published to the market, it may arise under Section 1041H because failing to inform the market that its published guidance is no longer accurate could constitute misleading conduct on its part. And then it has a bunch of bits and pieces, questions and answers around that. Don't know if that helps, but that's what I came up with in the listing rules.
Yeah, it does help, Cam. And as I said, that's obviously what we're referring to then, that particular rule around analyst forecasts if the company's not giving guidance. And while it doesn't state the number, I believe the understanding or the implication is around 10%. When the number diverges more either direction than about 10% is what the reasonable person or the reasonable investor is considering material. So whether that's completely accurate at ASX level, I don't know, but historically at least, it sounds like it's been around 10% when the letters have been sent out. Is our understanding?
Yeah, look, my only comment is it's very general. It's a lawyer's picnic, and you try and prosecute on this kind of thing because who's a reasonable person? What do they expect? There's also other carve-outs around, did you think the information was sensitive to your corporation, etc. So if it was 10%, I think that would be much more helpful. Putting some actual numbers and hard rules around this would make it much easier to regulate and make it easier for boards too to think about what they need to do.
Well, that sounds like a perfect question to ask the ASX GM. Why don't we add a particular percentage to that listing rule? So we'll send him that one in advance and see if we can get an answer on it.
Thanks, Steve. That's great. I've got a few things to go through here. I think, sorry, Cam, you've got some more to add? You look like you want to speak.
Are you still got questions for Stephen, or are we going to let him go? Because I had something I wanted to ask him before we let him go.
I'm finished, thank you.
Well, Stephen, we'll let you go, but I wanted to jump to after hours because I know you're a man who has interests in many cool things. TV, music, film, books. Give me what you got. It's been a while since you and I have had lunch and I've been able to pick your brain.
Yes, just finished season 2 of Severance with my son and absolutely superb. So love that. Can't recommend it highly enough. It was fantastic and kept getting better. And also Shrinking. I really enjoyed Shrinking, which is a comedy with Harrison Ford about a psychologist's office that Harrison Ford's running, which is also very funny and a bit of dark humour. So they've been my two star picks of the last few months, and of course listening to QAV every week as well.
All right, thank you, Steve. Good to catch up, mate. Let's do lunch at some point.
Thanks, guys. Really appreciate it, and well done on everything you're doing. It's great. Talk to you soon.
Thanks, Steve. Thanks for coming on. We'll talk to you about horses in the coming week. Not a great run by Double Market on the weekend, but just a bit of a trial, really.
No, I'm a bit worried she's a bit too smart for her own good, and she knew it was going to be hard, so she just treated it as a training run rather than trying. So hopefully that's not the case and she's not too smart for us. Anyway, onwards and upwards. Thanks again.
Thanks, Steve.
All right. Well, we're well and truly over an hour, even when I edit that down. Do you want to draw a line under it there and cover the rest of our notes next week?
I think we have to, yeah.
All right. Well, I was going to talk about Severance Season 2 as well. Have you been watching that?
I haven't. No, Jenny's still halfway through season 1, and I've been waiting for her to catch up. But I might have to sneak a few in myself because I've heard good things about season 2.
Yeah, I won't ruin the finale. Then the boys and I and Chrissy have talked about it quite a bit. You know, Taylor went to the event. He went to the cast event for it in LA. He just got himself an apartment in LA, by the way. He called me this morning. He's just taken a 12-month lease. Well, was about to sign a 12-month lease for an apartment in LA with one of his guys, Adam. He just rang me up to. It's funny. He rang me up. He goes, I just want you to talk this through with me. Make sure it's not a stupid decision. And I hear his girlfriend Amy in the background go, "Is that Mark?" I said, "No, he's talking to his actual father, not Ruddy. His not Ruddy. His other dad that he asks advice from.
His other dad called not Ruddy from now on."
Yeah. Yeah, so that's cool. But yeah, so they went to it, and there was some funny stuff that happened there, which I won't tell you because if you haven't seen the finale, it won't make sense.
Yeah, okay.
He was at a thing tonight. He texted me. He was in another for another show. Oh, it's a Seth Rogen show that's just come out called The Studio, where he plays a movie producer or something. Big cast. Oh, no good. Yeah. Well, he said Bryan Cranston was at the event that they went to tonight. Bryan Cranston walked past him, so as big fans of Breaking Bad and also whatever his comedy was. What was the comedy before that?
Malcolm in the Middle.
Malcolm in the Middle, yeah. The boys and we're all big fans of Malcolm in the Middle.
Really?
It was a great show. Even Fox has watched the whole thing. Fox binged the whole thing.
Wow. I'll have to check it out. I always thought it was very anodyne. Sitcom.
Oh no, it's very good. Yeah.
Oh, okay.
It's very good. It holds up well too. It's anyway. I've been reading the Ipcress file.
Yeah.
Halfway through that.
And
enjoying it.
It's great, isn't it?
Yeah, I'm enjoying it.
Yeah.
Really enjoying it. And I've been listening to a lot of Italian hip hop this week. When I'm not listening to Shostakovich, I'm listening to Italian hip hop as part of my immersion in Italian language. Lots of Italian hip hop, which is cool. What about you?
You've been seeing those articles. I keep getting articles every now and then on my stream saying you can buy a house in Italy for $1 as long as you renovate it and go and live in the village after everyone's left it. Have you thought about doing that?
I've thought about asking you to buy me a house in Italy.
For $1?
You can come and stay whenever you want.
If you do it up, yeah.
I'll do it up, sure. I've got nothing else to do. Yeah.
What about me? Well, I just finished Source Code. It took me a little while to read it, but really enjoyed it. The early days of Microsoft, or early days of Bill Gates, but the last half of the book was the machinations about getting Microsoft off the ground and corporate, malfeasance with their partners and doing deals, and it's actually a really good read. So I enjoyed that.
What's your take on Bill Gates?
Oh, that's a hard one. Really smart guy, nerdy guy. I'm going back maybe 20 or 30 years, but for a long while there, he was the Elon Musk of his day. Sort of a little bit too much power in the hands of a rich person, perhaps. But I was always influenced by Buffett, who thought Gates was a smart fellow and good enough, decent enough to put on his board. So I kind of watered down my view of Gates and softened towards him over the years when I read more about how Buffett thought about him.
I'd never thought about that before, but you're right. If he's good enough for Buffett, if Buffett respects him and his integrity and his character, that says a lot. If you think that Buffett's a good judge of character and a good guy, as we do, and an honest guy.
Yeah.
I've always, I've been a fan of Bill since, the 80s, and then worked there for a long time. And, I hear lots of bad stuff about Bill, and I've never been able to sort of pass it with my connection with him and sort of, I won't say relationship with him, but, met him a couple of times. I think he was, in the 80s, 90s, just a very, very ambitious, autistic nerd who... and very super smart, and then got his legs cut off during the DOJ thing in the early 2000s and realised he hadn't played the game, and he had to play the game in terms of political engagement and that kind of stuff. I remember I was there at the time. I remember we had one guy in Washington. Like, we didn't have a team, we didn't have a department. There was one guy whose job was to sort of be in Washington and be there to meet people and talk to people. And it was like, for what Microsoft's role in the economy was and its position as a target, it was like completely understaffed and underthought through. And it was a big shock, I think, to Bill,
Right.
when he got hauled over the coals for what he just thought was business. You know, yeah, I crushed my competitors. That's how we survive, right? It's a cutthroat industry, tech, and, you know, we're just smarter and better at it than everyone else. So why is that a crime? And
So what you're saying is it was another Washington shakedown. Hey, you haven't greased our wheels enough. You haven't got enough staff over here taking us out to lunch, and we're going to get you. Yeah.
Yeah. I think it was. But and then, you know, he always said before then he was going to spend the first half of his life making money and the second half of it giving it away, and he did it. Like, he didn't just talk about it; he did it. And when you know about his parents too, and the kind of people they were, highly respected, you know, members of, you know, WASPy community in Seattle, but you know, respected lawyers and board executives, his mother, and that kind of stuff. So anyway, I've always sort of been a supporter of Bill's. And he had some marriage problems and, you know, may have had some illicit relationships with women and employees, and he's paid the price for that in terms of his marriage and his, you know, I don't think he was involved in any dirty way with Epstein. That just doesn't track. And again, when you take the Buffett thing into account, yeah, it just doesn't. Buffett wouldn't be associated with as closely as he has been with Bill if Bill was that kind of guy, I don't think.
Yeah, you'd expect that. Yeah. But yeah, I mean, I remember way back when Warren first met Bill, and he put a lot of his feelings about Bill into some of his writings. And, you know, Bill's the smartest guy I've ever met. I didn't want to meet him. Someone introduced us, and then I found out, you know, sort of 4 hours later, we'd been talking nonstop for 4 hours, and he was just impressive. And then I'm not sure who introduced the giving pledge to who, whether Bill introduced it to Warren or Warren to Bill. But yeah, that's certainly one of the most impressive things about Warren and Bill, is that they're giving away their fortune. It's not going to their kids. It's going, a lot of it, some of it is, but most of it's being given back to the societies that help make them.
Yeah. I'm pretty sure it was Bill that introduced it. I mean,
Yeah,
it was part of the
right.
Bill and Melinda Gates Foundation idea, I think, but may have come from somebody to them. I can't remember the genesis of it, because there were some interesting philanthropists that they got involved with.
Right.
Yeah, that's interesting.
And I remember,
I
remember when the foundation was being talked about, and it still stayed with me. I mean, Bill's just great at distilling things down to their core principle. And he may have been during an interview when someone said, "What's the philosophy behind the Bill and Melinda Gates Foundation?" And he said, "The philosophy guiding it is that every life is created equal." And when you think about that, you know, it allows you to then build on that and say, well, where can I have the best bang for my buck? It doesn't have to be in a Western country. It can be preventing malaria in Africa or whatever. But I just thought that was an amazing way to approach a charitable foundation, was go back to first principles and let that be your guiding light.
You know, Chrissy and I were sort of talking about this during the week. I've been reading this biography on Shostakovich, and it's sort of an example of why that's important. I mean, okay, so he's a composer. He didn't cure cancer. He wasn't Einstein or whatever, but generally considered one of the greatest composers of the 20th century, if not the greatest, and probably one of the greatest composers of all time by most classical music nerds. And he was born into a relatively poor family, where his father died when he was very young, just prior to the revolution. His mother she had like 4 or 5 kids, single mother. During the revolution, the economy of Russia was wrecked. And he was a very sickly child, had a lot of, medical conditions, very sick, very weak. But he was a prodigy, a musical prodigy. And so he ended up at the conservatorium in St. Petersburg at 13 and had to get sort of financial support by some of the early Bolsheviks were providing financial support for him. The guy Glazunov, the composer Glazunov, who ran the conservatorium, wheedled grants out of the government to give him support. He had to get a job playing piano in silent movie theaters when he was a teenager to help pay for the family because they had no income and all this kind of stuff. But it was this great composer who, if he hadn't have got financial support from the state and from friends and patrons around him, probably would have not survived long enough to compose all of this great music in the 20th century. You don't know where the geniuses are in society. They could come from poor, underprivileged families, and if we don't give them medical care and education and opportunities, then all of society, not just in that case Russian society, but globally, we've benefited from him or from an Einstein or from a Madame Curie or, take your pick of people that have, created penicillin or created whatever it was. Yeah. Cement, which we can talk about in our next show.
Okay. Yeah, no, I agree with you 100%. You don't know where the next genius is going to come from. And technology is a part of that.
Not necessarily from the richest families, the richest
probably
1%.
Not from the richest 1%.
Yeah.
Yeah, technology plays a big part in that too. I think it was Coppola who said, you can make a film on your phone these days, so that he's looking for the next Coppola to come from, the slums of Brazil or something like that gets hold of cheap technology and goes to, just goes to town with it and makes a great movie from it.
Yeah. Well, I'm waiting for that to come out of AI generated stuff too. Like there's plenty of people now. I saw an animated film just the last day or so. It's like a 5-minute animated short about a bear that saves the life of a raccoon or something, and then they become best friends and they go on this journey together. It's like a Disney animated thing, all made with AI tools. By a guy who's a professional animator. He said this would have taken a year. I did it in like a week with these AI, or hours, I think he said, or something like that, with days with these AI tools, just telling it what to create. So there will be great pieces of art created with these tools that people couldn't have done before because they couldn't afford the budgets for it. And so, yeah.
Yeah, no, definitely.
All right. Well, apologies if we didn't get to questions this week. We'll do them next week. It was a really, really good conversation with Stephen Mabb. Thank you to Stephen for coming on again and walking us through the ASA's view on those things. I look forward to his report back in a few months when he has the sit down with the heads of the 5 families. And Tony and I are going to go down and do an American show.
Yes.
For Americans out there.
Talk about how important it is to maintain Medicare and Medicaid and aid to people.
They love that. Yeah. They love that kind of talk over there.
Yeah.
Thank you, TK. Right, have a good week, everyone.